Hello, everybody. It is John Lore, and I'm coming at you live with another segment of Trading with Livevol. I'm filling in for Stephen Choi today, and glad to be here. So, filling in today, if you've been trading or looking at the markets, you know that, again, there is nothing going on. Markets like this are great when you have theta positive positions on. But are terrible if you're looking to start new positions or jump into the market, because without any action, there's usually no opportunities in order to take advantage of. So right now we're just sort of sitting here. We're not doing much. Volatilities are low, so there's really no premium to sell, and it's just sort of a sad state of affairs in order to initiate any positions. Now, if you already had some things on, then you're just collecting money, and you're sitting pretty, so you're just hanging out chilling. But as of right now, for me, looking to initiate some new positions, kind of a sad state of affairs. So I think mostly people are waiting on the FOMC and all the announcements this week. I'm going to share my screen here, and I'll show you what I'm talking about. So if you look, here's the Bloomberg economic calendar. This is free. Highly recommend you bookmark this and check it out on a very regular basis. As you can see, bloomberg.com/markets/economic-calendar. And what you can see from here is that tomorrow, Tuesday, we have the consumer price index and the housing starts coming out. Then tomorrow, the FOMC meeting announcements, the forecast, and the chair press conference. Thursday, the jobless claims and Philadelphia Fed survey. And that's it for the week. So all the big major market moving events are going to have these red stars next to them. So I highly recommend that you bookmark the Bloomberg economic calendar and use this when you're looking to make adjustments to your position and when you're looking to initiate trades. Check this out. See what's coming up. This is going to be a good indicator also as to market direction and why, for example, today the market might be sitting here doing nothing. It's kind of because everybody's sort of waiting on these numbers to come out this week and see what is going to happen, what the announcements are going to be, and then subsequently a direction will be chosen and the market will either go up or go down from there. So we're kind of sitting in this no man's land, camp nowhere area. As I said before, waiting on some of these numbers. We just didn't get much clarity last week, so we're still kind of sitting here, which is just unfortunate. But I wanted to talk a little bit about a trade that I've been doing for about a year now. I've been doing it off and on for about a year. Typically, it's good for these short-term directionless periods. It's a trade that I learned from Jim Bittman, who I've quoted before, great options trader out of Chicago, CBOE. A lot of these things that people come up with are just things that are sort of reframed or tweaked or from other people. Typically, there's no revolutionary new trade that's going to come out. With options that's going to just change and be so creative and different. Usually it's just some sort of different take or slightly different tweak on a trade that somebody else has been doing or somebody learned from somebody else. And, this is the case with this trade. I'm not sure where Jim got the idea or learned it, but I picked it up from him, and now I'm passing it along to you. So it's called, it's a weekly trade on the SPX. I call it the weekly deviation strategy. I'm not sure if he has a better name for it, but essentially what you do is I'll pull up the rules here. These are some general guidelines for the trade, and remember, I like to trade kind of with general guidelines or frameworks, not robotically, but with general guidelines or frameworks. So we use Wednesday's closing VIX price to calculate a fourth standard deviation and a half standard deviation for the SPX. From Thursday's open, we then add and subtract a fourth standard deviation and a half standard deviation. Then on any day beating Thursday, if the market rises a fourth standard deviation, we're going to sell a bull put spread with a short strike down a half standard deviation, which was calculated from Thursday's open. Or if the market falls a fourth of standard deviation, then we're going to sell a bear call spread with the short strike up a half standard deviation calculated from Thursday's open. And then if at any time the market reverses and touches the opposite fourth standard deviation point, we're going to close the spread. So if the market initially rose a fourth of standard deviation, and then we opened up a bull put spread, and then the spread would be closed if the market reversed down and touched a fourth of standard deviation level. And from a profit perspective, we're going to let the trade run until expiration. So if all goes well, the trade will expire worthless, and you'll make your credit. So again, this is an SPX weekly trade. So the good thing about trading the weeklies is that you're going to have 4 opportunities every month in order to trade these things. So you get a lot more trading opportunities than you do on the monthlies, in which you only have 12 expiration cycles to trade. So you're going to get a lot more trading practice, which is good, especially if you're a new trader. And the other good thing about the weeklies is that we can do these sort of expiration style strategies in which you don't get as much opportunity to do on the monthlies. Mostly again because there's just so few expiration cycles. There's only 12. So this is a spreadsheet that I sort of created in order to track this and come up with the numbers and spit them out, so I don't have to do this every time. It's a little spreadsheet which I input Wednesday's closing price, the Wednesday close of the VIX, Thursday's opening price for the SPX, and then I have the standard deviation output. So I have 38 points being a standard deviation here, and this is a calculated sell. So as you can see, this is calculated. So that tells me how big of a move one standard deviation is, and then I know with some simple division how big a fourth of standard deviation move is, then how big a half a standard deviation move is. And then I go ahead and calculate a half standard deviation up and a fourth standard deviation up, and then a half standard deviation down and a fourth standard deviation down. And I calculate those from Thursday's open price. And then I can use these numbers to go then look at the SPX and follow it starting again on Thursday. And if at any point the SPX goes up a half standard deviation, a fourth of standard deviation, or down a fourth standard deviation, I know it's an indicator to open a position. And the position again would be if it moves up a fourth of standard deviation, which it did in this week. We got up to 1955, I believe, on the SPX. So that means I would have sold a put spread, half standard deviation down at the 19. In this case, the exact number would be 1924.35. But since we don't have a 1924 strike, we would sell the 1925 strike, and then you can go 10 points out and then buy the 1915, and that would be the spread that you would have put on this week if you were doing this trade. And then again, management is just the trade. So if the market then starts to move down and hits 1933, as you can see, that's the fourth standard deviation down mark, then you close the trade. It's that simple. So it's really just an opening of the position and then the closing of the position. There's not really a whole lot of risk management rules outside of that. Now, if you want to go ahead and employ some of your own risk management skills and tactics as far as hedging, maybe with some long options, or converting this thing to a butterfly, or rolling it down, whatever the case might be, you'd have to explore that, and you'd have to see how profitable and what the probabilities of profit are for that. But the strategy that I took from Jim, this is the pretty basic strategy of it, and this is just the way I've traded it. And again, I traded it for about a year now, off and on, with pretty good success. I averaged about 4.7%, if I remember correctly, on my winners, and it was a profitable strategy. So overall, I was up 4.7% on average on my trades. I do pick and choose when I put this on, meaning I'm very particular again, about opening trades with this strategy. So I won't just blindly open one every single week. I tend to stick to times when I think the market's going to be a little quieter, and I also tend to stick with times when we don't have all this economic news and stuff happening. So, for example, I did look at this trade this week, and I decided not to put it on because of all these announcements this week, and I didn't want to sit here through expiration this week. But let's say we get to Thursday, and after all these announcements are done, and I start looking at those numbers. Well, maybe next week I'll be a little more inclined to do it. Let's see. So we have existing home sales, new home sales, durable goods, GDP, jobless claims, and the personal income and outlays next week. So, a number of announcements next week. You're never going to get a week that has no announcements at all. So you just have to pick and choose, what you think. Are you comfortable trading it around the FOMC or not? Typically I am not, so I try to avoid that. The week after that, there's always going to be some announcements every week, so you're never going to have a week that's just free of announcements. But next week is a little bit more clear of the big major announcements than this week, which we have quite a number of big events that the market's waiting on. So you just got to pick and choose and see what you're comfortable with and what you're not comfortable with. So that's the trade for today. I'll write a blog post maybe tomorrow detailing it a little bit more, giving some examples so you can walk through it yourself. Give it a shot if you want. If I have an opportunity or when I put it on, I'll be more than happy to record myself doing that and posting that, and so you get a chance to see the trade in action. Until then, talk to you later.